afternoon, and thank you for joining us. Today's presentation is the first part of our mini-series, and we'll dive into the understanding of Sales Tax Nexus for your business. Your presenter today is Jeff Meggs with Tax Connects. Just a few housekeeping items before we get started. All your lines will be on mute and will remain on mute throughout the webinar. There will be 4 poll questions during this presentation. As a reminder, this webinar is not eligible for CPE credit. We will be providing a copy of the slides, and those can be found in the handout section of the GoToWebinar panel, and a recording will be emailed out later this week as well. If you have any questions, please submit them within the questions box on the GoToWebinar panel. There should be time for a Q&A at the end of today's session, but we can also take questions as they come in, so please feel free to submit your questions at any point. We'll do our best to get to all the questions, but if there's anything that should be answered in private or we can't get to them all, we'll respond to those afterwards via email. Thank you again for joining us, and with that, I'll pass it over to Jeff.
Thanks, Kate. And as everybody probably can see on their screens, there's a couple of gentlemen on this screen, one better looking than the other. I won't say which, but Brian is not going to be able to join us today. He usually does a good bit of this introduction statement and kind of guides us through this presentation. So you're stuck with me, and one of the things I'd like to just share with you just before we get started in the details is just a little bit about Tax Connects. We are a purely sales and transactions tax outsourcing business. Our primary function is to serve as a sales tax manager for our clients. We focus on small to mid-sized business market. We have about 350 clients throughout the U.S. and internationally. And we also do some consulting work, and my role in the business is actually on the consultative side. We'll do projects with companies that aren't in a position or aren't prepared to outsource the compliance function, but still need some guidance, still need to understand where they sit relative to the sales tax requirements. We also do a good bit of audit defense and help with due diligence efforts as well through acquisitions. So there's a lot going on here, but for purposes of today's discussion, we want to focus primarily on sort of the concept of Nexus. We'll get into a little bit of taxability, really primarily just to kind of give you a sense for the difference between Nexus and taxability. Not that it might not already be obvious to you, but we'll share with you some perspectives that kind of help align those two. And then finally, we'll wrap up with sort of a comprehensive discussion on pulling it all together. And once you've made some determinations or decisions about Nexus and or taxability, how to get into compliance registration primarily. Before we get into the first slide, I think we have a poll question that Kate is going to have you walk us through. So the poll question, really just want to get a sense for the audience. How would you describe your level of sales tax knowledge? Entry level, intermediate, advanced? And we're not going to quiz you after this if you chose advanced to see if you really were advanced. So just want to get a sense for kind of the dissection of what the group as a whole looks like. So we'll give you a couple minutes to answer that polling question. And as Kate, I think, mentioned during the course of this discussion, we welcome questions, and we will try to address those during the course of the presentation. And we always enjoy getting perspectives or sort of going off on little trails in terms of what people are experiencing out there. So it looks like we've got a fairly educated group from the polling question. Looks like over half of us are intermediate to advanced. And so hopefully I won't bore you, those that are in that intermediate advanced section, but we'll try to keep it interesting as we go forward. So the first thing we want to address when we think about sales and use tax is Nexus. And if that term's not familiar to you, you're not alone. Nexus is really the term we use to indicate that a company is operating in a fashion that would allow a jurisdiction to impose its taxing authority on the company. So if you have Nexus, that means you have a connection, you have some level of presence in a jurisdiction such that you would need to comply with their sales and use tax laws. And the reason we talk about Nexus in such a primary fashion and in sort of introductory fashion is it's the basis for everything that happens next. If I don't have Nexus with a state, I don't need to worry about whether what I'm selling is taxable or exempt. I don't need to worry about whether my customers have exemption certificates or not. I simply don't need to comply if I don't have Nexus. So when we think about Nexus for sales tax purposes, historically, and this goes way back into the 60s with some precedent-setting case law, but we really look at it from a physical presence test. And what we have here in this slide is just an illustration of some of the more basic, obvious to some people, not so obvious to others, but some of the basic items or categories of physical presence. An office located in the state, employees located in the state, inventory located in the state. Those are fairly obvious. I think everybody has a sense for that, why that creates Nexus. What does tend to trip people up are some of these other categories: attending a trade show or traveling into the state. It could be for soliciting purposes, or it could be just to establish or even maintain a market. So I may have a customer in a state, and I just want to go visit that customer just to get good feedback and represent that we care about what they're doing with us. And that alone could create Nexus for sales and use tax purposes. Usually when you're attending trade shows or you're doing any type of traveling into the state, we consider the number of days that you travel into that state during a 12-month period. And the standard that we typically use is if you've traveled into the state or spent more than 3 days in the state, we would say that there's the potential that a state with that information and that knowledge might assert that you have Nexus for sales tax purposes. The last box, which is kind of in the middle center, bottom part of this sheet, third-party contractors, is probably the one that we find catches people by surprise more often. And essentially what this is let's say you're in the business of selling copiers, and you don't have Nexus for any other reason in a particular state where you have a customer. You sell them a copier, and along with that copy, you decide to sell them a maintenance agreement or a service agreement. But to service that copier, it doesn't make sense to send an employee and incur the travel costs to service that particular agreement. And so you might engage a local contractor, a third-party contractor who has that specialization and can fulfill that maintenance or that service agreement on your behalf. When you do that, you're essentially leveraging the physical attributes of that contractor, and then in a sense, you're leveraging the infrastructure of that state such that that state could assert that you have now created Nexus. You've created a physical presence through that third-party contractor. So this is sort of the traditional Nexus picture that we have been accustomed to dealing with. And as you can tell, every one of these items has some element of some person or something being fixed in that state for some period of time. About 5 years ago, though, we had really a disruptive event that occurred within Sales and Use Tax Nexus. And that was the Wayfair decision. So from a pre-Wayfair perspective, as we've talked about, there was this physical presence and that characterization that drove the Nexus determinations. But building up to Wayfair for about a decade prior to 2018, we did see a variety of different efforts on the part of states to create an environment where companies were forced to comply or forced to register. Four of those scenarios are kind of listed here. Click-through Nexus really isn't a big deal anymore. It was a huge deal back in the 2010 timeframe. And it had to do with companies leveraging websites of a resident person or resident company in a state to drive marketing of their products. So that was a big thing that happened for about 3 to 5 years. Notification requirements was something that we saw start in Colorado, and then there were a number of other states that adopted something similar. And what they were really saying was, look, you don't have to register because you don't have a physical presence. But to the extent you meet some of these other criteria, which were generally revenue-based criteria, we're going to force you to send information, and you're going to send notifications to your customers that they have an obligation to pay use tax, and you're also going to have to send information to the state that lists out all of your customers and your sales. They were onerous. That nobody wanted to comply with those. And so what the state was saying to everybody is either comply with the notification requirements or register and comply. Cookie Nexus, whenever we're going on to a website of a company, there's always, not always, but sometimes a statement that there are cookies. Those are basically little scripts that are going to load down from the internet onto your computer, and they're going to give you a better shopping experience or a better experience navigating that website. So states started to say, well, if you're downloading these scripts onto people's computers, you're going to create a physical presence, and we're going to say that that's creating Nexus. It's quite the stretch. And finally, we saw economic Nexus standards starting to really crop up. There was a lot of discussion about it, a lot of debate, even at the federal government level. So we're going to hit pause and just do another poll question real quick, and then we'll get into a little bit of the Wayfair decision. And the question here is, when thinking about sales tax, what is your biggest concern? Keeping up with changing Nexus rules, understanding taxability, audits, or just the ongoing compliance?
And Jeff, we did have a question come in, so we can, while we wait on some answers here. Brian asked what the difference is between sales tax and an excise tax.
That's an interesting question. My natural reaction or response to that would be really nothing. Generally what I've understood is that an excise tax, a sales tax is a form of an excise tax. So in some states, you'll see different sort of language used. The Hawaii general excise tax might be something you're asking about or familiar with. We consider the Hawaii general excise tax to be a sales tax. Now, it is a unique application of sales tax or excise tax. So the short answer is I would say that they're not different, that sales tax is a form of excise tax. There are a ton of different types of excise taxes, both at the state, local, and federal level, however. So usually in our presentations, discussions, analytics, even in our compliance outsourcing, we refer to this as a sales tax in every state. So even when we're talking about Hawaii, we'll reference it as a sales tax. When we're talking about New Mexico, which has a gross receipts tax, we'll typically refer to that as a sales tax. So it is a good question. It does create some confusion, particularly when we're working with clients that are doing things or engaged in businesses that are exposed to a lot of variety of excise taxes. And there becomes a need for us to come together and reconcile which of those excise taxes can we manage for them, because we can't manage all of them. Some of them are too unique for us. Looks like the group, the majority of the group here looks like their biggest challenge would be understanding taxability. I think keeping up with changing Nexus requirements looks like about 20% of us, but most of us are challenged with the taxability. Fear not, we're not going to exclude taxability from this discussion today, so we're going to get into that here to some extent. And but let's kind of pivot back a little bit to what we were just talking about in terms of Nexus. And in 2018, a decision was handed down by the U.S. Supreme Court that's referred to as the Wayfair decision. Essentially what happened was South Dakota had enacted or legislated a pure economic nexus standard. It basically said if you had $100,000 in gross receipts or at least 200 transactions in our state, we would require, and we would conclude you have Nexus, and we would require that you comply with our sales and use tax laws. This was really unique for its time, but there had been a lot of momentum building up to this. So there were a lot of states that were watching this. There were a lot of states that were invested in this and were kind of behind the scenes supporting South Dakota. On the converse of that was there were a lot of companies that were watching this closely, and they were also compiling their own sort of war chest to kind of debate or fight this. What South Dakota did, interestingly, within this legislation was they created a way to expedite the legal process should the law be challenged by a taxpayer, which was a nice gesture. They thought ahead. They thought, while this stuff is in litigation or is being litigated or is being challenged, everybody's going to be sitting around going, well, what do I do? What do I start to comply? Do I just hold off and wait on the sidelines only to find that I've accrued a massive amount of exposure? So eventually, Wayfair being an online home store type e-commerce business, they were assessed. They asserted Nexus against Wayfair under this economic legislation. They were assessed tax. Wayfair fought it. Interestingly enough, when it went up through the Supreme Court of South Dakota, the Supreme Court of South Dakota ruled in favor of Wayfair and said that this was not constitutional. And ultimately, the state encouraged the U.S. Supreme Court to hear the case. They agreed. And arguments were heard sometime in April of 2018. It was really interesting. I had an opportunity to listen to the arguments and listen to the questions from the justices. And it was really difficult to get a read for where it was going to end up. I mean, it really sounded as though to us, based on my read, that the court would, again, rule favorably for Wayfair. So we were a little surprised that the Supreme Court did basically acknowledge or grant South Dakota the authority, in essence, to enact that legislation or to substantiate that legislation. After that decision, which happened in June of 2018, as I mentioned earlier, there were a lot of states that were already teed up to bring similar legislation, and that's what happened. So we saw a rolling of states, a lot of them within that first 6 months enacted their own economic nexus standard. Not all of them enacted the same exact legislation as South Dakota. Many of them did leverage or institute that $100,000 limit or threshold. It's an annual threshold. Sometimes it's a 12-month rolling time frame for that threshold. The overwhelming majority sort of took that approach. A portion of those companies, or states rather, did also enact a 200 transaction threshold. And then there's some other states that just kind of went their own direction. California and Texas settled in on a $500,000 threshold. Mississippi and Alabama settled in on a $250,000 threshold. New York took the approach of having a $500,000 threshold plus 100 transactions. And then there are other variables that are found across the state, some of them referring to that gross receipts as being a retail sale versus just gross receipts inclusive of wholesale sales. What I communicate to the folks that I talk to a lot is don't try to remember all of those thresholds or all of those variables. I just encourage people to think about it from a $100,000 perspective. I typically encourage clients not to worry too much about the transaction volumes. They can creep up on you over time, but it's really about materiality. It's really about what kind of financial risk is the company entering into by not complying. So I think the $100,000 threshold is a good, simple way of keeping the math in your head. And whenever you get to that point where your revenue exceeds $100,000 in a given state, you should ask the question, do I have Nexus? Do I need to comply? They are two different questions. you can have Nexus and not be required to comply. And we'll talk a little bit about that here in the next couple of slides. So we do have all of the states now having set their legislation in place. And when we say all the states, there are 5 states that don't have a state level sales tax. Those being Oregon, Delaware, New Hampshire, and Montana. Alaska doesn't have a state level sales tax, but there are city administered sales taxes in Alaska. And those Alaska local cities have actually formed a coalition and established their own Nexus threshold, and it's similar. It's the 100,000 or 200 transactions. DC, we treat them as a state. They have their own sales tax administration, their own sales tax laws and implications, and so their rules are very similar to any other state. So today we have the 45 states that impose a sales tax, plus DC, plus the Alaska locals. And the real message here is there's still a physical presence test. That didn't go away. So we still have to pay attention to that. But I think the economic nexus standard kind of shifts our mindset to more of a materiality question. In essence, if I have physical presence, but I haven't exceeded $100,000 in revenue in that state, maybe that's not very material yet. Maybe that's not a trigger that's going to cause me or convince me to try to proactively comply. But just understand that once you create Nexus and once you have Nexus for a period of time, there's an accumulation effect. The fact that you haven't registered means that there's no statute of limitations. A state could go back, on average, they go back 7 to 10 years for non-registered taxpayers. And so if you're not careful, you can find yourself with $70,000 a year in revenue that may be taxable, and it accumulates over 7 years, and all of a sudden you've got something that feels a little material. Or in another scenario, you might be positioning the company to sell, and the purchaser is undoubtedly going to do some due diligence, and more likely than not, they will uncover these Nexus scenarios, and they will escrow amounts that are associated with sales tax risk. In some cases, we've seen entire deals collapse because of the materiality level of the sales tax compliance and the issues thereof. So it's not as secretive of an issue anymore. A lot of companies during acquisition have sales tax as a really significant factor in the decision making and the valuation. I think we're coming up to another poll question. And this one is, how is your business currently managing compliance? And you may or may not be. It's not presumed that you would be managing any sort of compliance by being a participant on the call, but this is just for us to get an idea as to how people are managing it. And I'll tell you before you answer the questions, we are finding in a lot of the research we do and some of the Q&A that we've had across a number of clients is at different levels, there's still the vast majority of companies are managing compliance in-house. Doesn't surprise us. That's not a bad thing, by the way. The realization does start to become an issue when they find turnover and replacing those people, having quality processes outlined in the business. Those are challenges that everybody seems to face, but that's traditionally how most companies managed it anyway.
We did have another question come in. Michaela asked, when considering the economic nexus thresholds, do we include the sales to tax-exempt customers, or do we exclude those?
Very good question. It varies by state. I, again, tend to leave clients with the theory that you should consider all sales when evaluating your thresholds, and then drill down on that specific state. There are some states where the sales to exempt customers does not count towards the threshold. And so it is a very valid question and can have applicability in a number of scenarios. So wrapping up the poll question, just as I described, we got the results we thought we would get. The majority of our participants today are managing it internally. Um, some of us are outsourced. Looks like about 20% of the group has outsourced that function. So good data. So I told you I wouldn't leave taxability out of the equation. So when we think about sales and use tax compliance, as I said earlier, we first need to understand or determine whether we have Nexus. Do we have an obligation to even pay attention to the sales and use tax laws of that state? If the answer is yes, then we need to analyze the taxability of products and services. And the question that just was posed is another good point that's not a bullet up here, but the taxability can be a measurement of what you're selling, but it also can be a measurement of who you're selling it to. If you're selling it to Walmart and it's going to be a inventory item for Walmart that they're going to resell, that's not going to be a taxable sale. Walmart's going to issue a resale exemption certificate for sales tax purposes, and they're going to apply the tax at the point of sale. But just as I was describing, Nexus has different sort of thresholds and definitions across the states. Taxability has similar ambiguity. Generally speaking, all of those states that I defined as having a sales tax, other than those 4 or 5 that didn't, their statutes really start out with something that says the sale or use of tangible personal property is subject to the sales or use tax. So tangible personal property in general is the basis for almost every state's tax scheme in this regard. Services, it's fair to say that most services are excluded from the tax base in most states, but I caution you not to really take that and run with it. I can't tell you how often I talk to clients who say, we're providing professional services. And by saying that, they absolve themselves of having any taxability associated with those services. My question and follow-up to those types of statements is, well, tell me about your professional services. What are they? When I think about professional services, and I think this is true across the overwhelming majority of the states from the standpoint that these core professional services are or tend to be excluded, they include things like engineering, architecture, lawyers, accounting, medical provisions. Those are typically the professional services that kind of are characterized as not subject to sales tax. There are a lot of services that are taxable. Those can be installation services. Those can be shipping services or delivery. There can be configuration of software type services. Telecommunication services is the biggest probably in terms of the one that gets the most tax web relative to both state and local tax. So one of the things that really naturally happened as a result of the Wayfair decision, and we typically think about it as an e-commerce decision, meaning all those companies that were selling through their websites, now they've got to charge tax. And that's true. A lot of companies are now caught in that web. But really the ones that have been most impacted from our perspective are technology businesses. Companies that were pocketed in places like California or the Northwest or anywhere virtually, including internationally, that were selling digital products and services. Maybe they were selling downloaded software, or maybe they were selling cloud-based software, but at no point did they have any physical presence in the state. And as a result of Wayfair, all of a sudden, just the mere revenue generation is now put them in a position where they have to comply. So there's still an ongoing realization in that industry that there's some risk that has to be addressed. And it's not just their software. In those software companies, there's a lot of ancillary services that in some states are taxable. It tends to catch them by surprise. So wanted to just illustrate for you a few of the sort of conundrums, maybe I'll call them. This is simply a small piece of some of the tax treatment that we see across the different states. And you might look at this and go, well, that's attractive. A lot of these services are exempt. And you're right. And that's really the problem. The problem tends to be that companies that are based in these states that are providing some of these services, they get so accustomed to them being exempt, they just naturally default to that is the treatment in every state. They're always exempt. And now that they've got this exposure due to the Wayfair decision, they aren't adequately capturing the tax treatment across all the states. And the reality starts to set in that maybe their largest customer was located in Texas and they've been operating in California all this time. And all of a sudden there's an 8.25% tax hit on those services. If they're not out in front of that, then every dollar they sell, 8.25 cents of that dollar is going to be collected by the state at some point. They're going to find themselves under audit, or they might just be in due diligence, and all of a sudden that's going to rise to the surface, and it's an uh-oh moment. There's not a whole lot you can do about it. There are some mitigation options that exist, but it's going to be costly. So in any case, just wanted to share with you, these are more or less technology and telecom activities that you see. And I'll just kind of highlight the Florida CST and telecom. That's the communication services tax. The Florida sales tax, the state rate is 6%, and then you may have a local rate, they call it a surtax. It's about 1%, anywhere from 1 almost to 2%, I think, at the local levels. Those are counties typically. The communication services tax is a combination of 3 different taxes. There's a state component, there's a state gross receipts component, and there's a local component. All told, a rate for communication services tax could be as high as 13.5 or even higher percent. So for every dollar in telecommunication services, depending on what the specific service element is, you could have a 13.5% tax. Similarly, Illinois has what we refer to as the telecommunications excise tax. Back to an earlier question about excise tax versus sales tax. Here we see the term excise tax being used. And then there's also the infrastructure maintenance fee, which is a really small percentage on communications taxes. But again, similar to Florida, there's a state level telecommunications excise tax, and then there are local level similar taxes. And those can get into the 12, and I think they can get as high as 13% in total combined. So telecommunications companies are they're fraught with danger. And one of the things that really gets people surprised, and let me just say this, by the way, for those of you that are wondering why are we even mentioning telecom, there's a lot of companies out there that are in the telecom business that you don't realize are in the telecom business. It's an easy business to get into, particularly now that we have VoIP. And so there's a lot of companies that have ancillary telecommunication services they're providing along with some of their other technology services and products. So one of the examples here I wanted to illustrate with the next slide is California says telecom is exempt. However, there are about 115 cities in the state of California, mostly those that have higher populations, and they have what's called a utility users tax that can be as high as 9%. And so there again are companies. I did a due diligence project a number of years ago where my client was buying a telecommunications company. They had been operating in California, had not been addressing any of their utility users tax. And as a result, we came out of that with a very significant and material escrow associated with all their revenue in the state of California. The other thing that can happen that trips people up is we can be so focused on the state treatment that we lose sight of potential city treatment. I talked earlier about Alaska having no state level sales tax, but they do have a number of local jurisdictions that administer their own sales tax. Well, Colorado happens to be another state that really makes things difficult for us. I won't say it's the state always, but within Colorado, there's about 70 what we call home rule cities, Denver being one of those. And in those home rule cities, they'll actually have different taxability on certain products and services from the state's taxability. So in Colorado, you might sell downloaded software and you find that it's exempt from state level sales tax purposes, but your customer's in Denver and you've established Nexus in Denver and you can establish economic Nexus in the local home rules, and only to find that it's actually taxable in Denver. And on top of that, a lot of these home rule cities, the rates are not minimal. They're 4% in some cases. So it's not an immaterial potential issue for companies that are in the technology space. The last one I'll just illustrate is Chicago. Chicago is the only what I would call home rule city within the state of Illinois. The state of Illinois actually administers the Chicago sales tax, interestingly enough. However, Chicago does have a host of different services that they have chosen to tax, and they didn't choose so lightly. One of the examples is SaaS, software as a service. There is a 9% Chicago City sales tax on software as a service. It's called a non-titled property tax, personal property tax. It's essentially a sales tax. And Chicago is very aggressive about it. They follow in line with Illinois' economic nexus standards. And as we talk to companies that are selling into the state of Illinois, if they're of any substance, if they're selling SaaS, a vast majority of their customers are likely to be in Chicago, particularly if we're talking business-to-business transactions. So it's not uncommon for us to get caught up in a web there as well. So kind of recapping, we've talked about Nexus. Do we have a responsibility to comply with the sales and use tax laws of that state? Yes or no? If the answer is no, stop there. No further effort needs to be put forth. If the answer is yes, we do have Nexus, we then need to evaluate the taxability of our products and services and recognize that not all states are equal when it comes to applicability. Generally speaking, tangible personal property is always going to be taxable, but then you may have exempt customers. Could be sales to government, could be sales to nonprofits. But even in that scenario, be careful. Not all states exempt state and local government from sales tax. Not all states exempt nonprofit organizations from sales tax. It could still be taxable. Sales to the federal government are constitutionally excluded from tax. Here again, there's always a sort of caveat to every scenario in sales tax, it seems. In New Mexico, because they call it a retail gross receipts tax, they don't consider you to be taxing the federal government when you sell to them. They still consider that to be your tax and your responsibility, and it's not exempt. So there's some factors out there to just be aware of. But let's say we have Nexus, let's say we do have some taxable products and services, and we need to make a decision as to what to do next. Assuming that it's material, assuming that we've got accurate taxability and a way to manage taxability, we should probably go ahead and register and start to comply. And really what we're trying to do is get that statute of limitations running in our favor. For every period you're filing or reporting, even if it's not totally correct, you're at least starting to build some level of a statute of limitations. Statute of limitations for an active registered filer usually is 36 to 48 months. That just means that the state, if you've been filing for 5 years and you've been timely, the state can't go back and determine in year 5 going back that you should have charged tax to this customer on this transaction. That's been lost to statute, and you're free from that assertion. There is sort of a need to understand the local reporting requirements, whether that be state administered. In Georgia, where we're based here in Atlanta, the state of Georgia, we have every county has its own sales tax. It's all administered at the state level, so the taxability is fairly consistent. And then when you report on a single return, but there can be a number of rows or levels of reporting that happen on that single return because of all the local allocation that has to take place. With the home rule jurisdictions in states like Colorado, Louisiana parishes, some of the Alabama cities, you probably have a registration requirement with that home rule city if you have Nexus in that city. So just be aware that if you're actively engaged in businesses in those states, there's a potential you've got more than just state level compliance. The thing that does get people sort of frozen in time sometimes is that on every registration application for sales tax purposes, you're going to be asked to either provide the first date of taxable sales or the effective date of taxable sales. When did you start business in the state? And in a lot of cases, companies are just playing catch up. They just haven't been monitoring it closely enough. It hasn't been a factor. It hasn't been material. And so they're just now registering when in fact they had Nexus for the last 2 years. They get to that question and they freeze. In some cases, they freeze and do nothing because they just can't manage the alternatives. The alternative would be I put the original date that was 2 years ago on that application. The result of that is that the state's going to issue you notices for all of those periods going back 2 years, ask you to prepare and file returns for all those periods. That scares the heck out of anybody. So we don't want to do that. If we don't put the right date on it, there's usually a sentence at the end of this application that you sign that says under laws of perjury, you might be indicted for a criminal act by stating the wrong date. I've had direct conversation with different state agencies. I was on a call with a couple of the assistant secretaries of revenue in Pennsylvania a number of months back. And I just shared with them, I said, we run into a lot of different scenarios, some of them good, some of them not so good. Our business and our philosophy is compliance is the best option. It's better for everybody. Voluntary compliance is the basis of every one of these state sales and use tax laws. They don't have the resources and the wherewithal to audit every company out there. They need for companies to get into compliance. And if I tell them, which I did, that you've got companies out there that are afraid, they don't have the cash to go back and satisfy their prior period liabilities, and they're scared to go forward and not put a current date and get themselves registered and start complying prospectively. So I encourage my clients, let us do the registration for you, or if you're doing it yourself, just use a current or prospective date if you're in those scenarios. This assumes that you haven't been collecting tax in the past. This assumes that you've gone through a number of discussions and exercises in quantifying your liability, determining how far back you had Nexus. You might decide that registration isn't the first step. It could be that you want to do something in the way of a voluntary disclosure with a state. So I caution you not to just run head first into this idea. But if your prior period exposure is minimal and you haven't collected tax, using a current effective date is not the worst thing in the world. And it really benefits both you and the state to get into compliance and to comply prospectively. You are at risk. The state could always audit you and say you should have registered earlier. They're going to assess you. They'll get some tax penalty and interest. But it's the best option under a lot of scenarios. Another factor that does sort of create some problems, and some states are more difficult in this regard, making sure you're registering for the right tax type. You might be registering in Missouri, and there are 3 different registrations that might exist for you. You might be a retailer, which typically refers to someone that's operating inside the state borders, making intrastate sales. You might be a retailer for use tax purposes. So we call that retailer's use tax or vendor's use tax. Those are companies that are selling and shipping product from outside the border of Missouri, delivering into the state. Or you could just be a pure use taxpayer. It could be you're a contractor and you have to pay tax on materials that you import into the state. If you choose the wrong tax type in some states, you're basically going down a path of non-compliance because you think you're complying with the way you've registered. Meanwhile, the state believes you were subject to a different tax type, a sales versus use tax. And I know we're not covering that in today's presentation, but there is a difference. And so just be cognizant that it's a little more complicated than you might think. Another factor that everybody kind of blows up on is officer liability. And what I mean by that is every registration for sales tax requires at least one officer and their social security number be provided. That bothers everybody, and we get it. We understand that. It's just not something you can avoid. You're going to have to do it. And basically, the state's protecting themselves from the potential that a guy starts a business, starts to charge and collect tax, never registers, never remits that tax. Those are trust funds of the state that they're holding. And they are embezzling to the degree they continue to collect those taxes and use those taxes maybe to pay off their payroll or their inventory. And then the company goes bankrupt, goes upside down. The states will come in and hold those officers permanently, or they'll hold them liable for that tax. So it's something that has to be understood. Then you get into the complexity of compliance. It's registration, but then you're dealing with all the new technology that the states are employing. You've got login credentials, you've got an administrator, you've got dual authentication. Some of the setups in some of the states, for example, Ohio, it's a little bit challenging to get through their registration process online. Some of them are very straightforward and easy, so you'll find a little bit of variety there. And then have a plan. If you're going to go down this path, if you do have Nexus, if you do have taxability, and you decide registration is the next step for us, you need to be prepared to comply. And complying includes being able to charge tax on your sales, on your invoices, being able to handle the payment of tax through whatever e-commerce site you might be using. And then you've also got the idea that you could have returns, exchanges, things like that. Those have to be managed. So the intricacies of sales tax have to kind of follow the intricacies of your business activities. And you need to be able to get good reporting at the end of each month so you can execute compliance. And then exemption certificates. If you are in a wholesale capacity, even if you don't register, I encourage you to get exemption certificates from your customers in those states. So if 100% of your sales are for resale in a given state, you may clearly have Nexus, but we know all of your customers are exempt, or maybe your primary customer is exempt. You don't have any material taxable sales. Get that exemption certificate whether or not you decide to register and start to comply. I think we'll end here with a poll question and then address any questions that might be still out there.
Yeah, we did have a couple good questions come in. Ellen asked about the taxability of training and consulting services.
Yeah, it's a great question. We find that training comes in a lot of different varieties. We have online training, we have live in-person training, we have live online training. We have training that's associated with the sale of a particular software application. All of those factors can impact the tax treatment. Generally speaking, in most states, training is not something we find to be taxable. If there's a separate charge for it on the invoice, it's separately stated. Even if it is associated with the sale, more often than not, it's not taxable, but it is taxable in some states. Consulting really can fall in just similar to what I was talking about earlier with professional services. Consulting can be a lot of things to a lot of people. So you need to be careful in what it is you're consulting about. So if you're going in, for example, to consult with a business on what software applications do they need to adopt for their business, maybe you are in the business of selling those software applications, so that consultative charge might be taxable. If you're not in the business of selling the applications that you're recommending, that consultation is likely not taxable. So there's just a number of instances where some of those activities could or may not be taxable. Majority of the time, we would find those to be excluded from tax.
And then we had Lauren ask if equipment rentals fell under TPP or if that would be under services.
Yeah, another one that's a bit challenging. Generally, leases or rentals of tangible personal property are going to be taxable. I think you can think of them as almost like sales of tangible personal property, but there are special rules on leases. And a couple of ones you'd want to be aware of is if you're leasing equipment with an operator, meaning you're going to arrive at your customer's location, let's say it's a bulldozer, and there's going to be a person that's going to operate that bulldozer and conduct any and all of the activities that the customer needs. In a lot of states, that's going to be considered a service and not subject to sales tax. And then the other factor around leases and rentals is things that ordinarily might not be taxable become taxable because they're associated with a lease. A lot of the states, when they define the sales tax treatment of leases and rentals, they use the term the gross receipts derived from leases or rentals. And so in one regard, if you're selling tangible personal property, the law will say something like the sale or use of tangible personal property is subject to sales tax, versus the lease, which will say the gross receipts derived from the lease or rental of tangible personal property are subject to tax. And what that does is it casts a net across everything like installation, shipping, maintenance, insurance. It pulls all those ancillary charges associated with the rental into the tax base and makes them taxable, even if they're separately stated on the invoice. And I'm not suggesting every state's the same in that regard, but generally speaking, that's what you'll find. The last point I'll make about leases, that there are operating leases and there are capital leases. Those terms may or may not have the same meaning to everybody. I get it. But just understand that in some cases, while we may call it a lease for income tax purposes, it actually may be a financial arrangement rather than a lease, and it's not really an operating lease. And what that means, or what that does to those transactions, is it brings all of the tax liability up front at the time the lease is executed. That's when the tax becomes due if it's a capital lease. But the other side of that equation is those ancillary services, including the finance charges, are likely not subject to sales tax in that scenario. There's a lot of different rules on how to qualify whether it's a capital lease or an operating lease. Those differ by state. Can't really go into those in a lot of detail on this call, but it's a good question. There's a lot of variety or variability in the leasing industry.
And then one more question before we wrap up here. Karen asked what paperwork would be needed for foreign companies to get registered in this industry?
We struggle with that one the most. We will find ourselves engaged with an international firm that does not have a U.S. presence. And when we go to try to get them registered, we're not able to follow through the entire application because we don't have a corporate officer with a social security number. There are a couple of ways that can get resolved. Either they will engage somebody on the states or in the states to kind of be their representative in some form or fashion. I can't go into a lot of the details about how they might do that. The other option is you can get a taxpayer identification number, TIN, through the federal government for this purpose. We don't do it. We've tried to engage in those activities and help companies get those. We've not really been successful in it. And when we've tried to engage some of our partners, we have a lot of CPA firms that are partners of ours. Even they struggle with it to some extent. I think it's a lengthy process and it's somewhat challenging. So I know I'm not really giving you an answer other than to say it presents some challenges when you try to get an international firm registered for sales tax purposes, unless they already have an incorporated entity here in the U.S. or employees. And with that, we will wrap this up. Thank you everyone for participating today. I think as Kate said at the beginning, this is somewhat of a series. I think we are going to have, this was the 101. We're going to have a 201 where we'll kind of break down some of the elements we talked about today in a little more granularity. Believe it or not, it can get much more granular. So hopefully there's some benefit you got out of today's session, and we look forward to being able to talk with you again soon. Any other questions that you guys may have, feel free to reach out to us directly. I think there's some contact information that we're going to be providing, as well as a copy of the presentation. So thank you, everybody.